We are at the American Bankers Association. Thanks for joining us for ABA's Economic Advisory Committee press conference to assess the health of the U.S. economy and offer a consensus forecast on the path ahead. For those of you unfamiliar, the EAC is made up of top economists at ABA member banks, and it convenes during the year to discuss the nation's economic outlook and develop a consensus forecast. Following today's presentation, we'll have a Q&A session. Also, a reminder that this virtual press conference is being recorded and will be posted at aba.com later if you want to see a replay. ABA is very fortunate to have the world's top economists work at our member banks and volunteer to serve on our Economic Advisory Committee. Their twice-a-year forecasts are shared with our member banks across the country, including the many smaller institutions that do not have their own economic teams. The committee also shares its assessment with the Federal Reserve and separately with the public through the press release issued this morning. The timing of this latest forecast comes at an important moment for the Fed, which is having to take into account the conflict in the Middle East and what that might mean for the economy moving forward. The EAC also had to consider current events in their forecast. Our chair is ready to share the committee's assessment moving forward. When she isn't volunteering her time to ABA and leading the committee, Beth Ann Bovino serves as SVP and Chief Economist at US Bank. Beth Ann, thank you for serving as chair of the EAC and for overseeing the committee. We look forward to hearing more about the forecast. The virtual floor is yours.
All right. Thank you very much. It's good to be here. Obviously, there's a lot of news on the economy, but let me go a bit on what the committee discussed and the forecast that has come out for 2026 and 2027. First, I want to note that the forecasters were able to adjust their forecast for the Iran war. And the reasoning behind that is the forecasters believed the majority saw the Iran war as limited, with little impact in terms of impact on prices, meaning not expected to see sustained price pressure with impact on inflation expectations. What we did see was the majority continued to expect moderate growth, and the factors that we looked at included continued consumer spending, and this was helped by larger tax refunds and lower borrowing costs. We do see the spending to slow a little bit, largely because it came after an incredibly strong year in 2025. We do have stabilization in home building, also because of lower borrowing costs. We do see, I believe we have in our forecast probably the first time in several years where residential investment is positive, on a year-over-year basis. We do have a lift up in government spending that is largely driven by government spending recovery in the first quarter after the fourth quarter shutdown. The other readings for the year were moderate growth. And finally, in part because we do want to mention that the majority of forecasters do expect inflation to remain sticky through mid 2026. This is in part driven by higher oil prices, and we do expect, because we expect the war to be limited, we do expect inflation to moderate in the second half of the year. This would be for both total and core inflation. Finally, because the committee, the majority, have a somewhat benign forecast, the median probability of recession was lowered to 25% from 32.5% in September. Again, the reasons behind this was because of improved visibility and a smaller net impact from trade policy than earlier expected. Also, another boost for economic growth this year was strengthening capital expenditures, particularly to technology and artificial intelligence. I do want to note that while the majority does see a more moderate growth and a soft landing, there was more dispersion among individual forecasters during our discussions, with some being much more concerned about the economic outlook, with more risk for recession, and particularly with the focus on the jobs market. And indeed, today's jobs market might certainly lift their position. Finally, on the other end, we did see more optimism going forward for 2026 from a few other forecasters, and that was largely driven by the belief that the cyclical moves in the economy, the weakness that had been seen in 2025, are being filtered out into 2026. With that said, I do want to add one more point on the Iran war, since that is clearly the topic of the day. I want to point that all the forecasters saw the impact from the Iran war an inflation story, less than a growth story. Now, we do want to point that this is very the story from the Iran war is changing every hour, and that is recognized. But that is where we discussed this is what we discussed yesterday and the day before. The reason why we don't think that it's largely a growth story is because the U.S. is the largest producer of energy in the world and a net exporter. Finally, another reason was the U.S. economy is less energy sensitive than it was 40 or 45 years ago. Think about gasoline prices. Gasoline prices, gas miles per gallon in 1970s were about you've got 13 miles per gallon for any car on the road, whereas today the miles per gallon is about 25 to 26 for any car on the road. So this does influence the position on the growth story. We do see, as I mentioned, the median forecast still reflects limited impact on oil prices, which feeds into headline prices, and the committee also expects moderate spillover into core prices, which the Fed targets. I will stop there and leave it to the reporters to see if there's any questions.
Thank you, Beth Ann. At this time, we're going to open up for questions. Like she just said, if you're going to ask a question, please use the raise hand feature on Zoom by hitting the react button at the bottom bar to let us know and we can call on you, or you can put it into the chat on the side there. If you're not asking a question, please keep your line muted. We ask that you please identify yourself and your media outlet and try to limit yourself to one question at first so we can get to as many people as possible. With that, let's begin. Who would like to ask a question? Greg.
Hey, this is Greg Robb from MarketWatch. Can you hear me?
Yes, I can. Hey, Greg.
Hey, Beth, hey, could I get your reaction to today's numbers? I know, and sort of what do you think it means for the Fed?
For the jobs report numbers?
Yeah.
Yeah. Okay. So, certainly, and I do want to note that what I'm talking about is my opinion as the chief economist for U.S. Bank. It is not the opinion from the committee because they did not see the numbers yesterday. Very disappointing. It's hard to find a positive read in these numbers. We saw the jobs numbers. The change was pretty dramatic. We're looking at well below what the survey and what U.S. Bank was expecting. Net revisions were also disappointing. The unemployment rate stayed, still relatively historically low at 4.4%. But we do think structural factors are in play there, meaning that part of it is because the labor market the labor supply has shrunk, either because of tighter immigration as well as people leaving the labor force. So that explains, largely because of retirees. So that it kind of explains why the unemployment rate still seems to be better than expected, but we do think part of that is an artificial look. In terms of the Fed, I think the Fed remains now challenged between their two mandates. They've got the inflation risk, and that's coming from part now being more now exposed to the war in Iran versus the jobs report. So it looks like the strain between, or the tension between the two mandates is even more extreme today than what the Fed was probably thinking yesterday. What does that mean for the Fed? We think, I suspect, that the Fed will stay on the sidelines in terms of cutting rates. I do think that we could probably see dissents in the March FOMC meeting because of the weakness in the jobs market. But from the Fed's stance, they will consider that unemployment rate being so low, even if there is a part of it that could be artificially low, they're going to see that as so low, it's closer to what would be the unemployment rate at full, at basically at maximum employment, and the risk will then focus their attention will focus on the inflation mandate, I believe, at this point in time.
Okay, next we'll go to Hike and then Sam and then Stephanie.
Hey, Beth. Thank you very much for the discussion of the Iran war impacts and your thinking on forecasting it. I wonder if any member of the committee looked at natural gas impacts as well, since U.S. Being a large LNG exporter is also exposed to global price dynamics now, and how that could affect economic growth or inflation here.
You said, okay, I just want to rephrase what you said. You said, did the committee talk about not just oil prices, but talk about other factors, other commodities like natural gas? That's correct.
Specifically, yes, natural gas.
And you also said that given the impact on natural gas prices could very well go up as well, as they have. What's the impact on inflation from the U.S.? Because I believe the U.S. is a net exporter. Am I correct on that?
That's correct. So, the shutdowns in the Gulf are larger on natural gas side, LNG, Qatar being a large producer. So, and since U.S. is exporting, that has already kind of pressured domestic natural gas prices before any of war. So I'm just kind of curious if any of your members look specifically at that energy angle rather than just oil.
We did not, the committee did not talk about that. I can talk about it from an economic lens as a U.S. Bank chief economist, if you'd like.
Yeah, sure. Absolutely. Appreciate it.
So it just adds to inflation pressure in the United States. I would say, though, the U.S. is also exporting that inflation, given that the U.S. is a large exporter of energy, including natural gas. So I do think that, yes, this is going to add upside pressure to, for example, households, U.S. households, because natural gas is one factor that goes into other household services, particularly heating homes, for example. So I do think this just adds more inflation to what U.S. households have to address. And I do want to note one more point. I mentioned that the committee and myself do expect at this point in time, recognizing the extreme volatility in what we can expect with geopolitical risk, but the committee and myself still expect that the war will be limited. And also because the U.S. is a large producer of energy, including natural gas, and an exporter, that provides growth. However, as you had just asked, what does this inflation mean for households? It's going to be a boost. It's going to hurt household expenditures. And the thing that I didn't mention is while U.S. households on average have become, in a sense, more fuel efficient, if you look at average household spending on energy as a percent of household after-tax income, it's now just around under 6% of income. In 1980 or in the 1970s, it was around 10%. So you saw it almost cut in half. However, one area that needs to be addressed is that it depends. It's not spread out evenly. Lower income households are in much more are in much worse. Uh, they have a much worse experience and from that level, I can say that lower income households spending on energy as a percent of income, we're looking at double digit numbers there. So indeed, while on average the U.S. households are in better shape, it's certainly not spread across the income spectrum evenly, and that just adds more to affordability challenges in the United States.
Next, we'll go to Sam.
Hey, thank you. And appreciate the context that you provided on fuel efficiency vis-a-vis the 1970s. I kind of wanted to stick to that theme. I know that you mentioned that the oil price component has, and the Iran component has, led the committee to believe that there might be some stickier inflation through the mid part of the year. Wanted to see if there was a lot of chatter last year about the risk of stagflation, and wanted to
Hmm.
see if those risks are now more pronounced given the oil shocks, given the stickiness that we're seeing in certain forms of inflation and the kind of weaker retail sales and jobs data that we got today.
Right. We have at U.S. Bank.
Hmm.
Actually, let me see if we have that. I believe we have in the forecast, in the consensus forecast, uh, what we're looking at here in terms of risks. I believe that's in there. Downside. The more I would say, okay, so I can only speak from my position as a
Understood.
U.S. Bank chief economist. I have had what as a chief economist at U.S. Bank, the risk of recession. Now, I can give you my individual number. The probability of recession over the next 12 months, and this is actually before uh, the Iran war, we had it at 35%. We lowered it to 30% most recently, and the reason why is because the trade dispute seems to be much less of a shock on the economy than what I, as chief economist, had expected last year. Indeed, when you look at the so-called effective tariff rate, worries had been in April that the effective tariff rate could go up to 20%. We had seen it maybe stabilizing at around 16%, which we thought the U.S. could absorb, but the risk was very high, so we had a high risk of recession. However, because the trade dispute has seemed to be less of an impact on the U.S. economy, we lowered our effective tariff rate before the Supreme Court decision to around 10%, which did have a softer impact on the U.S. outlook. So that's one reason why we lowered our forecast. Now comes the Iran war. Now we haven't factored that into our forecast because it really just happened last weekend. But I would say that we had been concerned about a stagflation scenario for some time. We look at the weaker jobs numbers that have been through 2025, and certainly another weak number this year, and we're looking at now the concern for sticky inflation has been a risk that we have noted even before the war in Iran. We had inflation peaking at over 3% by second quarter of this year, and then slowly coming down. My concern, is that the war with Iran could push that up even higher. Again, a stagflation scenario cannot be ruled out at this point in time.
Thank you.
All right, next, we'll go to Stephanie and then Alyssa after that.
Hi, thanks for the call. You kind of touched on this quite a bit, but how do you see the consumer holding up? They have high debt levels. You're talking about higher inflation, and we have seen that K-shape widen into somebody called it the jaws of the crocodile. Are you seeing, is the upper level going to be enough to hold up consumer spending, or are you seeing the middle tier start to follow the bottom?
On the what in terms of consumer, just again, averages do not answer this question clearly, but on average, what we had expected is that last year, uh, consumer spending far outpaced inflation. I'm sorry, far outpaced growth in income on average. So this year, one would expect that that would become normalized. We would see consumers pulling back on average on consumer spending, in other words, to catch up to income growth. Now we have this shock, which then adds more challenges for the household wallet. To the point of who has been spending, what we did see is that consumer spending was largely tied to higher income households. The breakdown showed that higher income households remained incredibly strong through through 20 through late through the end of 2025, and we think that was largely because of equity prices and and strength in home prices, particularly equity prices, which had huge gains through 2025. The risk we see for higher income households now is, well, I don't know what equity I don't know what the equity market is doing right now, and I suspect it's probably down. That could then influence the wealth effect, lowering spending on high income households, or given the transfer effect for high income households children, because they don't get the transfers. So we are concerned about that. On the lower to middle income spending activity, that had slowed considerably since 2023. We think one of the big reason is, one, the stimulus that was provided during the COVID pandemic was removed. The stimulus, the larger jobless benefits, the stimulus checks, etc., were all removed. In addition, remember that there was a huge run up in competition of businesses for people for workers who are essential workers, even leisure activity, transport, etc. So we did see lower income paying jobs in 2021, 2022, incredibly strong. Wages were incredibly strong. That has also been come back to normal trend readings. So in both cases, lower income households, lower income workers, and middle income workers are now back to normal, with higher prices. Higher prices or sticky prices still a problem for lower to middle income, and now probably even more so when we go to the gas station. I suspect that the impact from the weakness in lower income household spending is likely to start to climb up the income ladder, meaning that middle income households will be squeezed, particularly after they fill up their gas tank with gasoline.
All right, we'll go to Alyssa, and then after that, we have time for about one or two more.
Hi, thank you all for taking some questions this morning. I wanted to touch base quickly on the labor market. The press release mentions that it looks like there was some growth in healthcare jobs, and that maybe the committee is expecting some improvement in the breadth of job growth this year. So I'm wondering if you can talk a little bit about where else we might see job growth in the economy.
I think we do let's see. Okay, so healthcare, actually, ironically, healthcare this month or February, healthcare job jobs were negative. I think probably that's the first time in I don't know how long. But we do think that's more of a mechanical factor. We do think healthcare is likely going to remain relatively strong. Think about in terms of, let's look at AI. Now we know there's a lot of business in terms of building AI data centers, which is not through. One would expect that construction activity would get a boost there as well. Look at Caterpillar. Indeed, Caterpillar is doing rather well because of that activity, or had been doing rather well because of that, the activity in data centers, which will continue through this year. Then the other factor would be, well, you have to fill those factories. So one would expect that manufacturing would also get some boost from this as well. In terms of leisure activity, leisure activity in retail, retailers, the question there is how will households continue to maintain spending through this year. We do expect household spending will hold up relatively well, though not as strong as 2025. But I would say from an economic perspective, and I am talking now from my view as chief economist at US Bank, I would say there's more risk in that area, largely because now consumers or households have to spend more on gasoline, so less money for discretionary spending. And we do see overall spending, we had expected it to slow down a little bit more this year anyway, because it's a catch-up period in terms of basically catching up on strengthening their savings, given that much of it was spent last year. So I would say worries that I would have would be more on the consumer side of activity at this point in time.
Okay, we have time for one or two more. Does anyone else have any questions? Going once, going twice. Okay, with that, we're going to conclude the press conference at this time. One programming reminder for everyone on the call. Next week, we host our ABA Washington Summit, which brings bank leaders from across the country to DC to engage in advocacy and hear from top banking policymakers. If you haven't already, I encourage you to reach out to our PR team to register. With that, thank you everyone for coming and have a great day. Bye.
Thanks, everyone.